So, hi all, welcome, good morning, and good afternoon to all of you who are logging in from different countries. So, all of you know me, my name is Deepesh. We'll be having a very small session on what are the different alternate products that we have to offer. And let me get started with this, and then we'll talk more of this. So, there are different types of investment products that we all deal with. Uh, Primarily we deal with mutual funds and REITs and ETFs. But in the last 3-4 years, there's a lot of new alternate products that have come as an investment product for all of us. So we have been doing the due diligence, checking out what's their performance, and then we thought that we will offer this to all of you. And we call this as structured products. Basically, these are offered from different fintechs, different institutions. So let me get started off. So before that, this is what normally people do, and what people do with their portfolio. This is the wrong way. In this investment pyramid, they keep cryptos, small penny stocks, alternates as their major chunk of investments. They top it up with real estate, gold, and invest every small significant amount of products in these kind of instruments. Pretty much these are safe. These carry the highest risk. Imagine a guy who had this kind of structure last year and crypto had fallen by 75% in the last 1 year. Imagine the kind of situation or the kind of wealth destruction that has happened. Ideally, alternate products should be in this way, and this is what I would like to present. That your mutual funds, EPF, PPS, PPF, FDs should form as a bulk of your portfolio. Around 60 to 90% of your portfolio should be this way. Then, you add real estate, gold, and then you look at alternatives, penny stocks, cryptos, and other structured instruments. Please remember, these alternates are not a replacement for your basic core product, which should be a part of your portfolio. Okay, yeah, and this is what we at Happy Investor have been doing, that ensuring that we manage the risk in a way that tomorrow, if anything goes wrong in any of the portfolios, in the long term, you should not be losing money, and hence in these 4 products, you don't lose money in the long term. So this is the agenda for today. What are the different alternate products options that we have to offer? Should you invest in this? If yes, what percentage you should invest? Who should invest and who should not invest? What are the risks associated, and what is the liquidity in each of these investments? Of course, all alternate products come with different risk, returns, liquidity. So how should you decide an investment product? What people do is that they only emphasize on this, the returns, saying that, I'll be investing. If I ask somebody that why should you invest, then people say that I will be investing in this product because this gives the highest returns. But you have to look at safety, liquidity, and then returns, and then make a decision on investing in that product. So what are the different types of products? Let me introduce you with these products. The first product that is very exciting is called as P2P. P2P stands for peer-to-peer lending, and this is offered by Liquid Loans. So Liquid Loan is a company which offers a product called P2P, and I will tell you how this works. Basically, this is a product which is similar to your bank FDs, and it offers you about 9.35% guaranteed assured returns. When I say guaranteed, it doesn't have any link with equity markets. And currently 800 crore worth of investments has been gone into these products across many investors to this organization. It's assessed by CRISIL. CRISIL is a rating agency, and it has an investor first approach. So what exactly is this product? I'll explain you in a bit, but a little bit more, that it is regulated by RBI, and all that money that you put in is getting into an escrow account. It aims to beat inflation by about 3 to 4%, tries to deliver the best risk-adjusted return. You can invest quickly and make and withdraw easily. Within 3-4 days, you get your money back. And you can all these are online digital, and this is how this product works. So I'll quickly explain you how this product works. You all know this companies like Dr. Batra, Udemy, TrueWeight, and various IVF centers. So what happens there is that, let's say I go to Dr. Batra and then I say that I need to get my hair treatment done. Dr. Batra says 2 lakh rupees and I don't have that money with me. What does Dr. Batra say? Okay, I'll give you interest-free EMI option. You pay me 20,000 for 10 months. So instead of paying 2 lakh upfront, you pay me 20,000 for 10 months. So I can afford 20,000 a month. I sign up. When I sign up, I give my KYC documents to Dr. Batra. Dr. Batra passes on my KYC to Liquid Loans. So Liquid Loans, in within 15 minutes, they assess my CIBIL score, whether I'm eligible to take a loan or not, and then they sanction the loan. If the loan is sanctioned, Dr. Batra receives about for 2 lakh worth of treatment. Dr. Batra receives about 1.5 lakh rupees from Liquid Loans. And Liquid Loan in turn receives 20,000 rupees for 10 months for what they have lent to 1.7 lakh rupees to that has been given to Dr. Batra. So in this, Liquid Loan makes a return of about 15 to 18% return, and you as an investor get about 9.25% return. This is how this product works. So these are consumer loans. So I need a small consumer loan. I want to take up an online education. I don't have money. I go to that Udemy. Udemy passes on my data to Liquid Loans. Liquid Loans then assesses my credit profile and then gives this money to Udemy. You give this money to Udemy and then I pay this money back to Udemy. This is how this structure works. Basically, this is what banks were doing. Liquid Loans has taken the customers of those banking channel customers. You in banks you have two types of customers. One, prime customers, where where they offer home loan, car loan, and then you have another set of customers where the bank offers personal loan and consumer loans. So Liquid Loans has targeted these kind of customers, and hence through this they have structured, and you get a return of about 9.25%. What happens as a default? If there's a default, let's say if I don't pay back to Liquid Loans, then what money that you have invested as a lender to Liquid Loans has no disturbance at all. It's like if Vijay Mallya has gone out of the country, then your FD in SBI has nothing to do with that, unless all become Vijay Mallyas and don't repay the loans. So this is what it offers. So it offers a bit of safety of lower default, highest rate of interest for discretionary loans, low concentration risk, because if you as an investor put money, then you will be investing, you will be giving some part of the money to to some set of people. So your money gets actually diversified across 200 to 250 different borrowers. So you can opt for fixed investment period, or you can opt for anytime withdrawal. It gives you regular monthly cash flow. Let's say you are investing 1 lakh rupees for 1 lakh rupees as a one-time investment. You get somewhere between 700 to 750 rupees per month credited to your bank account as it is. This is the first product, and this is how this works. So you have this option where the MHP stands for minimum holding period. Let's say you hold this for minimum 3 months, you get 8.6% return. So you invest in 3 months, you get 8.6% divided by 365 days into 3 months. This is what you get. You have, as you increase the tenure, 6 months offers you 9, 12 months offers you 10, and then 24 months offers you 10%. And when you renew this, you get a higher amount. Let's say you renew this, then you get a higher amount. So these are the products which are at fixed tenure. We'll take questions slightly at the end. We'll just finish off this, and of course, we'll take some questions. I know you have some questions. In case if you really don't want to lock your money, then there are other options where you say 12 months. If you stay invested for 12 months, you get 9%. But if you want to exit within 12 months, then you are settled at 7.25% return. Another option, you say 24 months, but if you exit within, let's say between 1 or 2 years, then you get first year 8% and second year also settled at 8%, depending on the number of days that you hold. So you have a fixed tenure and you have a flexible tenure. Depending on your cash flow, you can decide. The minimum investment is 50,000 rupees and the maximum investment is about 10 lakh. This is what the RBI covers. So this is all about Liquid Loans. This is the first product that I wanted to put this across to all of you. It's quite interesting. We at Happy Investor, we have been doing this for about close to 4 years now. And personally, my company's money is also invested in liquid loans as a lender. Yeah, for all the working capital money that we have, part of the money is being invested. Okay. So this is about liquid loans. Okay. We'll just open for one or two questions in case if you have, and then we will go ahead with the next. So there is no lock-in period. There is no minimum. 50,000 is the minimum. Just one or two questions, and then we'll move on to the next project. Yeah. Anybody would like to ask any question?
Dipesh, Rajesh here.
Yes, Rajesh.
You said about regarding the safety on default, right?
Yes. Yes.
So what happens if there is a default and are we still eligible to get the interest, yes, or it's the guarantee is only on for the principal amount?
Okay, so good question. So in case it doesn't default, you still get your principal, you still get your principal, you still get the interest. What could be the worst case scenario? Let's say another COVID comes and all the people who have borrowed the money don't have the jobs in hand, and then they just don't have the money to repay EMIs. At that time, this could have an issue, and that issue could be with your bank also, with any other institution. Let's say tomorrow nobody pays EMIs to ICICI Bank, and how will ICICI return back the money that you invested in the 50s? So that kind of risk always exists, and it's a universal risk, and you can't do away with that risk. But this company has passed the COVID phase. We were a little bit worried during the COVID phase because many people had lost their jobs, but nothing happened to the principal and the interest. They had, you can see here, they had 100% track record. So this is what you say, 100% is the success. Fine, I will take.
Yeah, but what could happen? Now, the worst case scenario, is there a possibility where a principal will be at stake?
Yes, in this world, except government bonds, everything is at risk. Tomorrow, a bank can also get closed. As bank, you could use a global trust bank, you could use a Lehman Brothers in US. You are seeing a credit. I mean, worst case, what could happen is that in case if you lend 1 lakh rupees, and then in case there's a liquidation of this company happens, when the asset gets sold, and then let's say everybody gets a haircut of about 25%, then you get about 75%. That's upon liquidation. Okay. So we will move on to the next one, and we will take all the questions at the end.
Sure.
I have it. Okay. Then the next product that is there for offering is tax-free bonds. Tax-free bonds are low-risk fixed income. Predominantly, they are issued by Government of India or government-backed institutions like RAC, NHI. These kind of quasi-government organizations issue these bonds. There's a fixed rate of interest. Currently, they are at 5.5% to 6%. There's absolutely no risk of default because it is guaranteed by Government of India, and hence assured income and capital protection is there. But they come with a longer tenure like 10 year, 15 year, and 20 years. So it's not that you want to invest for 6 months, so you really can't actually do that. The interest rates is locked for the period of holding. So let's say you get there's a bond which is trading at 5.65% interest. So when you buy that, you get an assured 5.65% every year for the remaining maturity of that bond. It is low. It has low liquidity as it is locked for longer period of time. The interest is completely tax-free. That is why it is called as tax-free, and they are offered by Government of India. For whom is this suitable? Somebody who is looking for a very long period of time, 10, 15 years, and they say, I really want to have a security of one part of my money. So instead of you buying insurance policies or doing bank deposits, you get 5.5% as tax-free. So 5.5% tax-free is somewhere around 8.5% pre-tax. In that, if you minus 30% tax, you end up getting about 5.5% to 6%. So link this as a product equivalent to an 8.5% product. So this is what these kind of products offer. So this is the next product. So ideally, who should invest is that senior citizens ensuring regular income with low risk of default they could look. Investors in the highest tax bracket to avoid tax on interest they could look. Investors who could lock their money for a certain period of time they could look, but it is not meant for everybody. How to invest? You need to have a demat account. We will facilitate this investment for you. It has to be brought in tranches as and when available with the seller. So there's a seller on one side. So basically, all these tax-free bonds were issued in 2012 to 2014. Now and they were issued for a period of 20 years. Now, so one guy wants to exit today in 2022, and he has a tax-free bond of, let's say, 10,83,000. So you have to buy the same amount of bond what is available with the other guy, and this is facilitated on demand. So you cannot decide that I want to put 5 lakh, I want to put 7 lakh. If there's a tax-free bond which is available at 7 lakh, you have to buy the entire tranche of some. But that's how this works. Basically, it's getting traded secondary market. One question on this product, and then we can move on to the next one. Anybody have any question? Okay, so I think it gives us pretty clear, simple, and most of you have understood. Let me move on to the next section. The third one is capital gain bonds. So basically, these I would not call this an investment product because you're forced to do. Basically, when you sell any real estate, it's subject to capital gain tax. We all know this. This tax can be short-term or long-term capital gain. In case if you want to reduce the tax, let's say you sold a property and there's a tax that's due, and you want to reduce the tax, then you need to, you can't reduce the tax unless you do some investments. But when you sell a property, you have to pay this long-term capital gain. So all these proceeds from the sale of this property, when you invest in this capital gain bonds, which is issued under Section 54, you have an eligibility to make this investments and save the taxes. These bonds need to be purchased within 6 months from the sale of the capital asset. Sell a property. Probably you all can mute. I'll suggest that all of you can mute. And the maximum investment that can be done is about the maximum investment that you could do is 50 lakh rupees, and locking for this 5 years. This is guaranteed by Government of India. I just have to mute all of you. So basically, this is a product which you have to forcefully invest to save any. So remember, tomorrow, in case if you have to sell any property, if your parents have to sell any property, instead of paying any capital gain tax, you can reduce capital gain tax to some extent by investing in these products. These products offer a guaranteed return of about 5% per annum every year for 5 years. Simple product. This is not an alternate product. I would say. This is meant for somebody who has sold his property. Okay. Then the next product we move in. These are called as sovereign gold bonds. So you all know that we could buy gold in two forms. One is physical form where you go to your jeweler and then buy gold bars, coins, and jewelry. The other one is you can buy in non-physical form, which is also called as paper gold. So of late, whenever we import gold, there's a lot of impact on our foreign currencies. So what the government has done is they have introduced something called as sovereign gold bond. Most of you know about this. These are gold bond issued by Government of India, and their denominations are in the grams of gold. We are substitute to hold physical gold, and investors have to pay price in cash or in bank basically in bank transfer, and the bonds will be redeemed again in the form of cash on maturity. This is issued by RBI on behalf of Government of India. So how this works is that, let's say today's gold price is 5,100, and you want to invest, then you want to buy 10 grams of gold, then you should be investing 51,000 rupees worth. Then you will get 10 grams of gold. Now you need to hold this for a period of 8 years, and every year on this 51,000, the government assures 2.5% interest on gold. So you never get interest on the gold that you have in your lockers, right? But here, when you make an investment, you get 2.5% guaranteed interest. So every year you get 2.5%. And at the end of 8th year, whatever is this value of this gold at the end of 8th year, that money will be credited back to your bank account. Assume that this value is about 75,000, then this 75,000 will be paid to you at the end of 8th year. And apart from this, you get this 2.5% interest every year for 8 years. So this is what this product is all about. So it offers in demat form. So you get it in demat form. And if you buy it in demat form, you get 50 rupees discount on every gram of gold. You can also buy physical, but you don't get a discount. Minimum investment is equal to 1 gram of gold and maximum is 4 kg per individual. That's what the limit RBI is. Can be bought when freshly issued by RBI or can be purchased from anyone who holds this bond. If somebody has held it this previously, they get traded on the stock exchange. If somebody wants is selling it, then you can buy that. The lock-in is 8 years, and when bought from RBI, it also offers interest rate of 2.5%. And at the end of 8th year, the value of the gold will be paid back to the bank of asset. So this is a good substitute for people who actually want to buy physical gold, and whom this is helpful for. Let's say you have a daughter and you are planning to accumulate some money as gold for her marriage or any such purpose that you want to hold for a very long period of time. Instead of keeping the gold in the locker, you could always use this offer as an opportunity. The good thing is that when you get this money, whatever appreciation that's happened, that is tax free if you are bought directly from the RBI during the primary issue. We will take one question before we move ahead. Any question from anybody? You can see some questions on the chat. So last two lines seems contradicting. Is the gains interest on tax free or taxable? So Ritesh, Ritesh here, if you directly buy from RBI, and you hold it for 8 years, then it's tax free. But if you buy from the secondary market, let's say somebody has bought 3 years back and you buy it now, then it's not tax free. That's the difference. Any other question? Yeah.
How is this interest credited? Is it credited to our account yearly, or is it at the end of 8th year we get it?
No, every year you get this credit in your bank account, which is linked to your demat.
Okay.
Yeah.
And is the interest taxable?
Interest is definitely taxable. So basically,
Dipesh,
yes.
As you said, anybody selling after 3 years. So the person who is selling after 3 years, say probably if I buy and I sell it after 3 years, so again, will I be taxed for that amount?
Yes. The rule is that
because it's 8 years tax free.
Yes. The rule is that you need to hold for 8 years to to make that appreciation tax free.
Got it.
Yeah, you are exiting in between because there's a liquidity need. Or sometimes what happens is you feel that gold has appreciated in a huge manner, and then you want to exit for some point in time, and then you may want to repurchase. At that time, you want to liquidate. Then it becomes a taxable product. Okay, we'll move on to the next.
Got it.
Yeah, okay, so we'll move on to the next one.
Dipesh, does this sovereign bonds are daily given by RBI or?
No, it's not given daily by RBI. So once in 2 months or 3 months, RBI opens a window. So they say that 28th November say 3rd December tak hum log khula rakhenge. In this window you need to buy.
So how will we able to know that?
So you can intimate us. You can ask us, tell us that next kabhi khulta hai to bata dijiye. We will tell you.
Okay.
Fine.
Thank you.
Then the next product that we have is this guaranteed income product, and this is offered by insurance companies. So I will just explain you how this works. So you all have this, LIC policies like Jeevan Anand, Jeevan Shri. Similarly, is this product. I'll just show you one illustration. This illustration has been taken for a 32-year-old male, and he wants to. So here is how this product works. So you pay premium for about 5 years. So every year you pay 5.9 lakh for 5 years. You don't get any money, but at the end of 12 years you get 50 lakh. So it's an amount like you pay for 5 years. So you can decide, no restriction that it has to be 5 years. You can say 5 years, 7 years, 10 years, and then you can decide at what time you want the maturity amount. Accordingly, the product gets fixed, and you get this guaranteed maturity amount. So it's basically a guaranteed income product. So somebody who is looking for a very guaranteed product, a specific guaranteed product, these are the options. If you actually go and calculate the returns are somewhere around 6 to 6.5% tax free, because this is an insurance product. It's tax free, guaranteed. What happens is that you lose the liquidity over a period of 12 years. So as I said, when you look at investment products, you have to look at safety, you have to look at liquidity, you have to look at returns. So safety is highest, liquidity is nil, returns are moderate, which is about 6.5%. Returns are moderate. So you can decide, how many years you want to invest. Minimum is 5 years, maximum is about 25 years, something like that. And you can say that at my age of 60 or my age of 70, I need this much of money, and that is what it will be created to your bank account. And you also get a death benefit with this illustration. If somebody takes this, there's a death benefit of about 59 lakh rupees. If it happens in any year, that's a death benefit that you get. If you want to surrender this, there's a minimum surrendered value that you get. But remember, the surrendered value will be lower than what you have put as a principal. So this is how this works. Remember, this is offered by insurance company. 6 to 6.5% is the tax-free guaranteed amount. You lose out on the liquidity part, but you get a lump sum amount paid to you one time. If you don't want a lump sum, you say I need a kind of a pension every year, and that option is also possible for you. So it all depends on how you want to structure this product that is possible. On whatever product premium that is shown, you also have to pay a GST. First year it's 4.5%, and then next year onwards 2.5%. And you can decide the premium payment term. You can do yearly, half yearly, monthly, like a mutual fund SIP that you do. This also. Okay. Any questions? We can take one question. We're halfway.
Dipesh.
Yeah.
Does the returns depend on the age of the person?
Yes, slightly. Younger you are, higher are the returns. Older you are, lower are the returns.
Okay.
So but the difference will be in the range of 20 to 30 paisa. It will not be 5 for an senior person and 6.5 for an younger. It will not be the case.
Okay.
Yeah.
So the medical thing will be there?
Yes. So you have to undergo medical test, and then once that is satisfied, because there is also an insurance on your life, so there's a medical checkup that also.
The premium will depend on that, like.
Premium will no. If the medicals are clear, you get the policy is issued. If the medicals have any issues, then the policy doesn't get issued.
Okay.
We'll move on to the next one. Then we have some other structured products. So these are slightly complicated in nature. This one structured product offered by Edelweiss. There are, it's called as market-linked debenture. Market-linked debenture. Debenture is something like a bond, It's market-linked. That means it is listed on the stock market. You get pre-tax opportunity lock-in at a higher pre-tax interest of about 9.5%. The principal is protected at maturity. So remember the word is principal is protected at maturity. The interest is not protected at maturity. I'll tell you more on this. It's tax efficient because you pay only 10% tax if you hold it for more than 1 year. And there are different ratings. So there are rating agencies who rate as who rate this product. So generally, AAA is the highest rating. Companies like Infosys, HDFC Bank get AAA rating, and the smaller companies, and then it goes as AA, A, B, C, and D is called as default. So these products are AA minus. This is where these products fall. And there's an independent trustee who takes care of the investors. So I'll tell you how this works. So the offerings are of two types: the debt part and the equity part. When I say debt and equity, the taxation is in the taxation and the returns are slightly linked with equity and debt. So the debt part, it's pretty simple. It's a 20-month product, and you get 9% yield. There's no lock. There is no exit in between. So you want your money after 20 months. You invest in this and then you get assured 9% per annum return. The principal is pretty much secured. Your principal and the coupon means the interest is pretty much secured against balance sheet of Edelweiss. So Edelweiss will be having assets like land, offices, bank accounts. So whatever money that you're investing, that is secured against all the assets that Edelweiss hold. And you get 20, you park your money for 20 months, you get 9%. Similarly, another product which is for 42 months and you get 9.5%. And whatever that you invest, 1x of that is secured on principal and coupon against balance sheet of this. Please remember, secured from security from Edelweiss and security from SBI FD are not same security. So don't think that security means subtly same security. It doesn't work in that way. In case if something goes wrong, then definitely principal is secured, but it is not liquid. Because tomorrow, if there's some issue with Edelweiss, I'm not saying there will be an issue, but if in case there's an issue, you not get your principal on the next day, it has to go under its own liquidation process. And when the liquidation happens, the investor gets the principal. That's what the meaning of security. This is the reason why we believe more of debt funds, mutual funds compared to structured products. But people who want higher yields, it's a great product to put in. So this is on the debt side. Simple product. Now there's something called as an equity product. This is very, very interesting here. Now this equity product is actually linked with Nifty. I'll tell you how this product works. In 3 years, let's say today's 12th November 2022, on 12th November 2025, if Nifty gives, let's say, 25% return, you invest 100 rupees, then at the end of 3 years, your 100 becomes 125 in stock market. Then you get this. But if Nifty gives you lower returns or negative returns, you get 6% guaranteed. तो अगर स्टॉक मार्केट ऊपर गया तो आपको स्टॉक मार्केट का रिटर्न मिलेगा. If stock market gives negative returns or lower than 6% return in 3 years, then you get fixed assured return of 6%. That is why it is called as twin win. It's quite interesting. It's quite interesting, and I think you would be surprised why they are doing it. It's basically a structured product. Okay. Then there's another similar structured product called as Leap Alpha. If Nifty gives you 1.1%, let's say your 100 becomes, your 100 becomes 110. If your 100 becomes 110, they'll pay you 110. But if there is a negative, number in the stock market, then you get only your principal. Let's say you invest 1 lakh rupees, and at the end of 3 years, Nifty has given negative returns. Then your principal gets protected. But if Nifty has given higher returns, then you get more than 1.1%. So this is called as Leap Alpha. I cannot explain the in-depth of this product because it has its own structures. Similarly, there is another product called as Beta, which says that if Nifty gives you if Nifty gives you more than 1.6 or 65% return in 3 years, you get all the upside. But if it doesn't give you more than 65%, you will protect the principal on the downside. So you lose only on the interest, but your principal is protected. So all this product structure, there is one thing common that is called as principal protection. So if you want to protect your principal, then there are different types of products that you could actually look into this, and you want to get an upside on the equity markets, then also protect your downside, then these are the products offered. And remember, all these products are again covered with Edelweiss assets. In case if there's a liquidation that happens, then Edelweiss assets would be sold, and then whoever has invested, the principal protection that you're talking about, they will pay. But that doesn't pay back on the immediate day in case if there's a liquidation. I'm not saying that this kind of issues will happen, but in case if that happens, that is the mechanism that will be applied. We can take 2 questions here, and 2 questions. I have 2, 3 more products to showcase. So please go ahead in case case if you have any questions.
Dipesh,
Yeah.
for leap, beta and alpha, what is the lock-in period?
These are basically 3-year kind of structured products.
Okay.
Dipesh, I've heard that typically structured products have again a minimum amount. Is that so with this?
Yes, 10 lakh is the minimum investment.
Okay. Thank you.
Like sorry, I didn't put this. I should have put this. The 10 lakh is the minimum investment. Fine. We'll move on to the next. Now we go ahead with another product. This is offered from a fintech called Giraffe. So Giraffe is a Bangalore-based fintech, and this is pretty interesting. And I'll show you how exactly this works. Earlier, there are some products which were only available for in certain league of customers with a net worth of 40-50 crore. They had access towards these products, and banks and other companies manufactured these products only for that ultra rich kind of clients. Now this product is being brought at the retail level as well. So where does this kind of product stack? So from a risk and from the return metrics, you have your fixed deposits, debt funds, and then you also have your equity markets. Between your debt funds and fixed deposits is where this Giraffe product gets positioned. So the risk is higher than your debt fund and FDs, and the returns are higher than your FDs and debt. This is where this product structure. So I'm just showing you that where it gets stacked. Let's look at this. What are the offerings that they have? So basically, they have 4 different products. The first product is something like a corporate debt. There's a company, let's say there's a company called Flipkart, and Flipkart needs about 100 crores. So they come to Giraffe and they say that we want to raise 100 crores, and they say we will, and then they say we will give you some kind of returns. Then Giraffe, you as an investor for Giraffe, you will invest in the corporate debt of Flipkart, and your returns are somewhere in the range of 8 to 20%. Companies which are strong and stable, they will give you lower returns, but companies which are new and then they have higher risk, then you are get rewarded with higher returns. The tenure is about 1 to 3 years. Typical like an liquid loan or a bank FD kind of a product. So you have a fixed tenure, you are assured with a fixed return, you invest and you take your money. That's product number 1 under Giraffe. This is a second interesting product which is called as invoice discounting, and this is very interesting. The tenure is somewhere between 30 to 90 days. So somebody is looking for a very short tenure can invest in this product. How this works is that let's say I am a distributor for Coca-Cola products for Bangalore division, and I have brought products from Coca-Cola and I am supplying to small general retail stores. Now these retail stores give me money in 30 days or 60 days. But I need this money immediately for my working capital. So what do? I show my invoice to Giraffe and then say that, hey, look, I have to receive an invoice of about 10 lakh rupees from different customers. So I hand over my invoice to Giraffe, which is what 10 lakh rupees, and assume that I hand over a receivable of 10 lakh rupees to Giraffe, and I get about 9.7 lakh rupees immediately. Instead of waiting for 3 months or 2 months, I get this 9.7 lakh rupees immediately, which helps me for my working capital rotation. So the gap that what you see is the returns that you get. So there are different vendors. Somebody who is supplying transportation service. Somebody who is actually looking for somebody who is supplying transportation services to ACC Cement to transfer cement from one place to other. They have receivable from cement companies. Somebody have receivable from Flipkart and Amazon. So they all get their invoices paid after 30 days, 60 days, but those retailers cannot wait for those time. They go and discount their
disturbance is there.
Dipesh, can you please put everyone on mute?
I will just do that.
Thank you.
Yes. Everybody is on mute, but if anybody has a question, I mean, if anybody wants to discuss, they can unmute themselves. I'm not permanently unmute everybody because I need the interaction from you. Okay, so this is what this product offers: the invoice discounting, rate of return of 9 to 14 and 30 to 90 days. This is second option number. This is product number 2. Product number 3 is asset leasing. So asset leasing works in this way that let's say I decide to open another office and then I need about 100 computers, 100 laptops. I don't have that money. So 100 laptops cost me about 5 crore rupees. 50,000 into 100 laptops cost me 5 crore. I don't have that money today. I go to Giraffe and I say that, hey, look, I'm buying, I want to buy laptops. I need 5 crore. What Giraffe does is it procures 100 laptops for me. And then I am supposed to pay every month as a leasing. I lease those products from Giraffe. So let's say 36 months, every month I will be paying a fixed amount to Giraffe. I have bought 100 laptops and every month I will be paying some money to Giraffe. And at the end of the tenure, whatever is the price of that laptop, I'll directly buy from Giraffe. So this is called as asset leasing. Tenure is between 2 to 3 years and rate of return is about 12 to 20%. Generally, Uber cars fall under this. So there's a company who actually leases this car to Uber drivers. Uber drivers, not all the drivers own their cars. So you will pay money to Giraffe. You will invest your money in Giraffe. Giraffe will go and buy Uber cars and lease it to these drivers. At the end of the tenure, the drivers buy back their car, and that's what you get your money. So you invest some lump sum and then you will be getting an equated monthly installment every month for a period of 2 to 3 years. So this is how this asset leasing works. It can be an example of what I have told you about this product called Uber Cars. It could be an office expansion of fintech or any other thing. And all these assets are secured against that. All that money that we invest is secured against the assets that are bought. So all those cars are in the name of Giraffe, and then in case if tomorrow money doesn't come in, then Giraffe will auction those cars and then pay our money. So these are in the range of 20% return and the tenure of the investment. So this is the fourth option is revenue-based financing. I'll just skip this. This is pretty high risk kind of a product, and this is not open, but it is there as a part of presentation. I'll just skip this. This is not available for investment as of now. So these are the 3 different products under Giraffe. Pretty interesting. These are not something new which has come out. Basically, all this deal and structuring were done by high net worth investors who are investing 5 crore, 10 crore, 15 crores for office leases and things. And these are being brought to the retail investors. Any questions here before we move further to the next section? Maybe we can take a couple of questions here. Any questions? In case all of you wish to know any specific product, I'll be sharing a Google sheet and then you can put your name and then which product you wish to know more. You could explain one-on-one, post this call also in the comment.
I have one question.
Yeah.
Is there Giraffe will have probably invested in many sectors, right?
Yes.
So is there a choice where we can, if we want to maybe get into asset leasing or invoice discounting, are there particular sectors we can choose and sectors we can avoid?
Yes, you can do that. Let's say you want to avoid any real estate sector, you could do that.
Okay.
So
that flexibility is there.
Okay. Yes.
Okay.
And these gets open only at a particular window. Like it's not available throughout the year. They come out saying that we are having an invoice discounting product from November 11th to November 20th. And then in case if this sector is real estate sector and then you don't want to invest, then you skip this. So it is not open throughout the year. Whenever the other organization needs money, at that time they come to Giraffe, and that's the time it gets open. Generally, what I have seen is that the moment it gets open, within 1 or 2 days it gets subscribed and then it gets finished. Yeah.
Thank you, Dipesh.
Dipesh,
Yeah.
Will they tell us what is the margin we will be getting when we buy the product?
Yes. Here it is a broad range, but you will be told that, let's say if it's 12.9, you will be told that it's 12.9 exactly.
Mhm. And how do we approach, like when do we come to know that this window is open?
That we will help you to do that. You can also directly register with Giraffe online, and you can do this. And we would also, it gets facilitated to us also.
Okay. Do they have any kind of report wherein they can let us know till now what has happened, like how many people have failed, or
till now,
the kind of
okay, till
yeah.
now, whatever that I'm showing, none of the products they have failed, and that is why I'm bringing this to all of you.
Okay, yeah.
There are more number of products which have failed in our due diligence that we saw. Hence, we are not putting this across. Yeah.
Dipesh, is there a minimum amount for the investment?
Yes, in this invoice discounting, it starts from 95,000. Corporate debt starts with 1 lakh rupees. So all these are like less than 2 lakh rupees is what you can say. Less than 2 lakh. That is why it is called as a pure retail product. Yeah.
And Dipesh, these are all pre-tax.
All are pre-tax.
Right?
Yes. You will be paying, certainly you will be paying taxes on all these. Only asset leasing could have an additional tax advantage because you will be investing in an LLP, and then the LLP makes the investment. So you get it slightly tax. Okay. Then let me move on. Then there is another product, but this is slightly different. So this is called as EIF, Alternate Investment Fund. And basically this is a SEBI regulated product. So like how mutual funds are regulated, even this is regulated by SEBI. However, you need to notice that this investment starts with 1 crore and above ticket size. But however, most of you may not would like to invest this kind of money in a single product, but it's good to know. So how this AIF works is that there are different bonds. Right? There are different bonds, and then there's an assured return that's told that you get a return of so much percentage. So the number is pretty much defined, and the tenure is locked in 3 to 3.5 years. And then the interest rate for that holding is locked in. So there is no risk of any interest rates going up or down. Equity market risk. You have nil liquidity. Our suggestion is that you should be investing only when you hold a product of 5 crore. Only when you hold a net worth of about 5 crore. If you are having only 1 crore and you say that put all my money here, I would not be comfortable in advising this product. The good thing is that in case there's a default, about 10% of the default is absorbed by the company which is offering. So the company that we're talking about is Vivriti Asset Management. So it's offered by Vivriti. So let's say you invest 1 crore rupees, and then 1 crore is put in different types of bonds. In case there's a default in this bond, up to 10% is absorbed by Vivriti's own capital. So some corporate don't pay, and if that is less than 10%, then you don't have a hit on your principal. Beyond that, there is a risk on the product, and this has been subscribed by all these companies or banks. Basically, they invest in these kind of products. If the bank has to be, you lend money at 5, 6, 7 to the bank, some portion of the money of the banks goes into these kind of structured products. The reason why this is kept at 1 crore rupees because the regulator SEBI doesn't want any retail investors to participate and then lose their money because these are slightly higher risk products. These are not your traditional debt funds or these where you don't have a chance of losing. So this is what this product is about. And it's there for last 4 years. We have done the due diligence and we are satisfied with whatever is offering. Finally, you all invest again in mutual funds, and in case if you want some sudden money for about 2 months, 3 months, we suggest don't redeem. You can lean that That means, you can pledge on your mutual funds and get an loan on that. And all this happens in 15 minutes. Rate of interest is 9% and it's 100% digital process. There's an app offered by Mirae Asset Financial Services. This is the non-banking financial. I just mute everybody for I muted everybody. So you all hold mutual funds. So when you redeem a mutual fund, you have to pay exit. You may have to pay exit load at some point in time, or capital gain taxes come. If it's for a very short period of time, you can definitely borrow against those mutual funds, and then you could repay that back. For equity funds, you get 45% of the value. So if you have an equity fund worth 10 lakh rupees, you can get a loan of about 4.5 lakh rupees. For debt funds, you get 80% loan on the value of the debt. And the loan can be up to 1 crore rupees. So if you have a portfolio of 2 crore rupees, usually you could get a loan of 1 crore rupees. For any short-term requirement, I would suggest don't redeem, use this facility. 9% is the rate of interest. You may feel that why should I pay 9%? But if you don't redeem and then the market goes up, you will benefit from that. It gets offset. So it's very simple. You download an app, select what mutual fund you have to lien, one-time KYC, and then the lien gets marked. You set up the bank mandate, you enter the agreement and put the OTP, your OD is ready. All this happens in 15 minutes. Some of you who are present here, we have done, you must be knowing that, we have offered this and you would have got this loan in 12 minutes. As simple. So we have brought this facility for that's it. As I promised, that will close by 12:30, and this is what we have 5 more minutes. We can take up some questions. I'll also be sharing a Google Sheet in the chat box. Please share your feedback and let us know if you're interested in the product. And as I said, we are open to add more products only when we do due diligence and we are satisfied with the safety, liquidity, and returns parameters. Anything that doesn't strike for us, we will not do this. There are plenty of products available that more than what I've showcased to you. Somewhere where I'm not comfortable, we would not certainly like to bring this to all of you. And even if you don't want to invest, but still it's good to know, hence we've had this presentation. Thank you so much. I'll be putting this link in the chat few minutes. Please don't log out. We'll just be closing in another 5 minutes. If you have any questions, please feel free to ask. Yeah.
For this capital gains bonds,
yes.
Any other alternative instrument?
You have to invest in something called as the startups. I mean, there are some government specified startups, and in those startups you can invest, but nobody does that. Nobody does that because you never know what is the risk associated with that startup. You may or may not get your money back. So, so I will be sharing this recording with all of you, and I also put the Google Sheet form here, so you could always check and in case if you want to know more about this product, we can always have a one-to-one discussion on this product. I'll be sharing this recording as well. Any other questions?
What is the tenure of the loan?
There is no tenure of that loan. So 1 year is the OD facility, and after 1 year you have to renew that. The processing fee is about 1,500 rupees. So you use this, and then at the end of 1 year you don't want to continue, then you close off. But you want to renew that OD, that's again 1,500 that you need to pay. You will only be paying the interest for that money that you have withdrawn. So if you have taken a loan for 10 lakh and today you have 5 lakh rupees, you put that 5 lakh back to that account, then only 5 lakh of interest is charged.
Okay.
Yeah. Any other questions?
Yeah, Dipesh,
yeah.
So this feedback form that you had sent, right?
Yeah.
What were the other common feedback that you received? Some some pointers, right? The results. So basically, the results of that feedback.
Okay. So, and there were, that feedback was more for our internal improvements. Some clients had some issues with their insurance. It got it elongated for a long time. So they said that please prepare an process when you have to recommend insurance. So we got different feedbacks from different clients based on whatever their experience was with us, and that's what it is. But more or less, this was the common feedback that we gathered across so many responses that we got from all of you. So basically, we always have that approach that we always want to improvise on this. Sometimes we never know where are we lacking. Sometimes we never know where we have to improve. Different. You all come from different backgrounds, so we ask this feedback to tell you that you tell us where we should improve, and then we'll definitely put our time and efforts there to improve on those things. Yeah.
Okay. Thank you.
Yeah. Thank you. Yeah.
Dipesh, I have a question.
Yes.
This one, like this giraffe product, right? Where you were talking about the invoice discounting.
Yes.
How frequently does that open up in the market, or like
every 15 days it opens?
Okay.
Indian entrepreneurs always need money, so every 15 months, every 15 days, these products get opened. But we decide which one to subscribe and which one to let go of it.
Okay.
Yes.
I see.
Any other questions? Fine, then we can wrap up, and thank you so much for attending. We have 2-3 minutes. Any other general opinion you wish to give, not from this session, or any other suggestions that you wish to give, please help us to improvise, because all that what we look at is that how can we offer something better than what we were offering in the past.
Deepesh, can I speak?
Yes, Rajesh.
Deepesh, see, this invoice funding, who's the regulator? Is it SEBI or somebody else, or MCX and all that?
Basically, these products don't have regulators.
Then that's the risk we have, because I have encountered such things in my organization. That is why I asked this question.
Yes, risks do exist in all these products. Some are quasi-regulated, some are fully regulated, like that AIF, which was worth 1 crore rupees. It's completely SEBI. Some are regulated by RBI, some are not at all regulated. But like cryptos don't have regulations, but still people invest. That is why if you go back to my first slide, I say that these products has to be on the top of the pyramid and not at the bottom.
No, I was a little late, so I missed that. That's maybe that's why this question arose, I think.
So the point was that you should not be for those who came late. I'll just put this across. For those of you who came late, please understand that this product cannot be a replacement of your mutual funds. These products need to come here. The allocation should be lower, because if this gets knocked out, financially it should not affect you. This is your base should be stuffed with this, whatever that you like, then with this, and then with this. You should not be having this kind of structure where you invest because it gives higher returns, you invest maximum amount, and then these gives moderate returns, and then you put low amount. That should not be the case. Okay. Yeah. And then thank you so much. We are just I wanted to show a couple of disclaimers. So because this is a recorded session. So these are the disclaimers. There are different risks that are associated with different products. And there is a liquidity risk, there's a safety risk, there's a return risk. We know we have to do the due diligence, but risk is a risk which sometimes cannot be avoided. That's it. Thank you so much. As promised, we are winding this at 12:30. Thank you so much. Have a good day. Have a good week. Thank you.
That's what we are thinking.
Thanks.